I always say that the idea that returns are tied to risk is one of the greatest lies ever told on Wall Street. And investment bankers and investment advisors promote this mythology because as long as the clients believe that they have to take greater risk to get greater returns, the manager essentially escapes accountability. And what they're not told really very often is that the person they're speaking to is really a salesperson.
Well, we were talking about GameStop. GameStop shares, they are surging this morning, up by about 26%. This move comes after the video game retailer announced Friday that it made $933 million from selling 45 million common shares. Yahoo Finance senior reporter Inez Ferre standing by in the newsroom with more on GME. Inez, what do we know?
Yeah, Brad, and GameStop took advantage of the short-lived meme rally mid-May by selling, as you just mentioned, 45 million shares to bring in almost $1 billion, according to a Friday statement. The share sale is important because the video game retailer has struggled as a business in recent years.
Thanks for joining the Father Emmanuel Lemelson podcast, which reveals the darkest corners of government, Wall Street, and culture with commentary from an Orthodox Christian perspective. Join our co-host, Theodore Lemelson, for another thought-provoking episode as we plumb the depths of Wall Street, discuss the reemergence of the GameStop frenzy, and examine the difference between speculation and investment. If you value our content, please like, share, or comment, and remember to follow us on social media.
In January 2021, a short squeeze of GameStop stock led to major financial consequences for some hedge funds and large losses for short sellers. The short squeeze was purportedly triggered by users of the subreddit Wall Street Bets. Some brokerages like Robinhood halted the buying of GameStop and other securities, leading to criticism and accusations of market manipulation. The stock price peaked at over $500 per share, nearly 30 times the $17.25 valuation at the beginning of the month, then fell and rose dramatically in the following months. GameStop stock is now surging again, and speculation that Keith Gill, known as Deep F Blank Value on Reddit and Roaring Kitty on YouTube, may have a substantial position in the company. Gill posted what appeared to be a snapshot of his portfolio on Reddit, showing 5 million shares of GameStop worth about $116 million and 120,000 call options with a strike price of $20. As the CIO of Lemelson Capital Management, you were ranked among the top equity funds by Hedge Fund Research in December 2023. Your investment research has been cited in various prominent publications and credited with influencing share prices. You've been in a battle with the U.S. regulators over lagging pharmaceuticals and faced unlawful prosecution, which included allegations of fraud which were rejected by a federal jury. Additionally, you've been recognized as an, quote, outspoken short seller and as a mentor and advisor to Mark Wahlberg, as featured in the HBO Max docuseries Wall Street. On February 9th of last year, you took on the executives and board of publicly traded Geospace Technologies, which you had a substantial stake in at the time. Let's jump into an excerpt from your call.
We'll take our next question from Father Emmanuel Lemelson with Lemelson Capital Management. Your line is now open.
The bottom line here is that under the current leadership of the company, something like 97% of shareholder value has been destroyed. Retained earnings and owner's equity has dramatically been reduced. And the only way you guys have come close to break even this last quarter apparently is because of an equipment loss. The board's bloated. Management salaries and benefits are always hidden in SG&A, which is always going up. The quantum acquisition hasn't really panned out. And it just feels like you guys are always hanging a carrot in front of investors. But in the meantime, while the board and the management team is pretty well compensated, investors are getting hosed. To me, that looks like corporate governance failures. And it really should lead to Rick Wheeler's ouster. A board that leaves a management team in place this long, with this many losses, what is it, 42 quarters of losses? The price of oil goes up, you guys lose money. The price of oil goes down, you guys lose money. The economy's great and booming, you guys lose money. The economy's doing badly, you lose money. That's a corporate governance failure. And I think until the investors and the board are honest about it, you're going to keep losing money. Every conference call, somebody asks Rick Wheeler, when are you going to be profitable? He can never give a clear, intelligent, solid answer. Investors should be very concerned about that. I've always said you guys have great technology, you've got great R&D, you're sitting on a ton of assets, but the day's going to come when you run out of real estate to sell. And you're going to run out of hard assets to sell to buttress your cash position. These are just not adequate answers for investors. And I think the company needs to take a hard look at who really owns that company and start thinking about why these failures are going on year after year after year.
That day, the company's stock price hit an intraday low of $5.23. 1 year later, on February 7, 2024, the stock traded at an intraday high of $16 per share, a gain of over 200%. How is what you do different than what's going on with GameStop?
These two stocks can be looked at in parallel because you have two companies that were relatively small, both with losses. I think between 2019 and I want to say 2023, GameStop had significant losses. I think in their most recent fiscal year, they earned about 1 cent a share, about $7 million. I believe their market cap right now is around 9 or 10 billion. I think in the 2021 era, their market cap must have been 40 or 50 billion, I want to say, something like that. At the height of the last frenzy, it could have been higher, actually. Don't quote me on that. But the fact is that the company had declining sales for many years. And apart from this meme frenzy, which is the epitome of speculation, there was really no underlying value, in my opinion, because you had declining revenues and you had very massive losses, actually, between 2019 and 2023, frankly. In the case of Geospace Technologies, you have a company that had de minimis on declining revenues, but had by 2023, their fiscal year in 2020, September 2023, had earned a substantial amount of revenue per share. I think that their net earnings were just under $1 a share. So when this stock was trading around $5, about 20% of the stock price was EPS. And so in that sense, you would recover the share price in about 5 years of ownership. In the case of GameStop, even today at $28 a share or whatever it's trading at, if you've got a penny in earnings, you're looking at 2,800 years to recover the price of the share. So certainly has nothing to do with value. And we can generally think of value as being associated with what investors truly do, which is to find value and to hopefully pay a fair price or better than a fair price. I think for true value-oriented investors, they really want to look for price-value dislocations where the price is demonstrably below the intrinsic value of the company. When we were having that call with the CEO and management team and the board at Geospace Technologies, the company at that time had tangible book value over $10 a share, so twice what the price of the shares were. And in our appraisal, the value of those assets was even greater than what was reported on the balance sheet because of the amortization and the depreciation associated with a lot of the equipment we thought was probably valued at more than what they were holding on the balance sheet, and more importantly, their real estate assets, which were being held at cost. We certainly had a sense that our margin of safety was greater than 50% at that point. And although not unlike GameStop, where there was quality issues with the management team, there was a changing business model, those things they had in common, we actively engaged with the company as the owners of the company. And I think today, owners of common stocks, owners of common equity really need to think about the fact that there is really no such thing as a passive investment. That's a misnomer, in my opinion. When you own something, you should be actively engaged with what you own. And most people are with other asset classes. When it comes to real estate or even their automobiles or some other item, they're very much so engaged in their ownership. For some reason, when it comes to common stocks, they disengage in the sense of ownership. And so even where there's a problem with the quality of a management team or where there's a problem with a business that is in flux or needs change, if you have that margin of safety, if you have paid a price that is less than intrinsic value, you certainly are involved in activity that you've done a thorough assessment of the financial showings of the company through analysis of their financial statement, and you have this appraisal value. What's going on with GameStop is, again, the epitome of speculation, which is a fancy word really for gambling. And I often tell people, gambling is an activity that's probably best left in Las Vegas. In fact, if you really have a proclivity to gambling, you'd be better off just going to Las Vegas because you could have a fancy dinner and see a nice show when you lose your money. Wall Street's far more efficient. You won't get either of those two things. And in the case of GameStop, it's remarkable because undoubtedly there would have been massive losses from the last debacle, not just on the side of the hedge funds that were short the stock, but surely it would have taken, if the media reports are right, it would have taken a lot of retail investors to bid up the price of those shares. And surely many of those people lost money because on each side of the trade, there's a winner and a loser. And when a few people make a very large amount of money, as happened with GameStop, there has to be a very large number of losers. And I'm sure that also happened. And here we're seeing a redo, we're seeing a repeat of that debacle. And I think anytime you look at something like that and you say, this is really people saying that the value here is a price movement, right? They're watching price. I doubt that this roaring kitty, that's probably the more accurate pseudonym for him to use, actually, because what he's doing has nothing to do with value from what I can tell. The real activity is to make sure that there's a higher stock price tomorrow or the next year until he can liquidate his position. And the fact the company was able to profit off that back in May to the tune of, what was it, 993 million, I think, or no, 933 million. That's remarkable because that company earned only $7 million in the trailing 12 months. So that's, I think, 133 times their actual earnings. So this company's really, their primary economic activity is stock sales. It's not actual economic activity from the operations of the underlying business. Could it improve in the future? It certainly could. But if you're talking about a stock you're paying $28 for today that's earning 1 cent and earned only $7 million in the last 12 months, that's an extraordinary premium to pay. And again, if you compare that to a real deep value issue where we're not out there using pseudonyms and playing games, literally playing games with the stock price, where you're engaging the management team and holding them accountable as shareholders should, that's a very different activity. And in my opinion, that's really what real investment is. So again, we had this sort of margin of safety. We had an appraisal of value that we thought was greater even than tangible book value, that is to say the equity in the company. We were engaging the management team when the price was at least 50% below book value at GAAP, and probably more like 60 or 70% below intrinsic value, according to our estimation. Called for changes. Those changes did take place following our involvement. And of course, as you pointed out, the stock rose about 200% in the ensuing 12 months. We did not keep our position in that company because we didn't believe that the management problems and leadership problems would really be solved in the long run. We do still own a small stub stake at Meteoric. I think it's 88 shares. In the interest of full disclosure, we don't have any position in GameStop. But I think both of these issues are extraordinarily instructive for those who would approach public markets to say, what the extreme of speculation and what is the extreme of deep value? Not deep value, as this Keith Gill character calls it. What he's doing has nothing to do with deep value. Really, he is just a roaring kitty. But I think these calls and this engagement with boards and executives, hopefully that will be truly instructive to what real investment looks like, because there can be great value to be uncovered in markets for those who are willing to do the work and understand this price-value dislocations that can exist from time to time. And frankly, because of the foolishness and the madness of crowds like we see in the GameStop frenzy right now.
On Sunday night, Gill posted a cryptic picture of a reverse card in the game Uno on X, which quickly gained nearly 30,000 likes. Shares of GameStop jumped more than 19% in Robinhood's 24-hour exchange Sunday evening. Gill's return to social media 3 weeks ago sparked a rally in GameStop, with shares more than doubling in May alone. GameStop raised more than $900 million in a stock sale during the May rally. Gill, in 2021, encouraged retail traders to squeeze out short-selling hedge funds in GameStop through YouTube videos and Reddit posts. The 2021 Mania led to congressional hearings about brokers' practices and gamifying retail trading. GameStop is transitioning to online gaming away from brick-and-mortar video game purchases. Let's compare Gill's game-like approach, going as far as to use game cards, to the remainder of your very different call with Geospace Technologies leadership. Let's jump back into the call.
Well, I think in many respects, you're really all wrong about how the business operates. I mean, in most respects, we're managing ourselves.
Destruction of shareholder value under your leadership, Rick. Is that wrong? Am I overstating? I'm understating that number. Businesses exist to earn a profit and to increase the value of their shareholders' wealth and their investment in that business. You've not done that. You've been in reverse for 8 years. Is that not a true statement? Show me where on the income statement or balance sheet I'm wrong. Look at your retained earnings. You've eroded them. Look at your shareholder equity. It goes down every single quarter. That's straight.
Right, but that is a fact.
What are you going to do about it? And that's what we got to find out.
Well, I think that's something that you're seeing. I mean, to the extent that we're restructuring what we're doing and aligning ourselves with those components that are more revenue producing, you are going to see that occur.
I hope that's true, because honestly, I think this board should be cut in half. I think it's extremely bloated for a company with your market cap. And honestly, Rick, you should step down. Your performance has been terrible economically. You seem like a nice guy, but I think these shareholders would rather have an effective CEO than a nice guy. And this is just an indefensible performance. The price of oil shot up, you guys can capitalize on it. Your competition is capitalizing left and right. There's record spending with E&P companies. Somebody just asked your CFO. He answered, we're going to be cash flow positive. That's not that encouraging. Look at your burn rate. The bank's cutting your credit line. Your cash is constantly dwindling. You're selling real estate left and right, but you're going to run out of real estate. The fact of the matter is, when Gary was running the company, he was a great CEO. But Gary's retired. He's out on some exotic vacation every time I talk to him. You're not Gary Owen, and that's the problem here. And all of those assets were accumulated under Gary's leadership. And now we're just burning through them. Look, this isn't an indictment of you personally, Rick, but something's got to change, and it's got to change quick. And you got to get all these academics off your board who all they talk about is playing with rocks. And you got to get some people who understand Wall Street on that board, because that's who you're talking to. You're talking to Wall Street.
In the fiscal year-end period ending December 31st, 2023, the performance of your fund was 383% net of all fees and expenses based on preliminary unaudited results. The S&P 500 TR, the benchmark, which includes the reinvestment of dividends, returned 26.27% during the same period. Is the long-held investment banking dogma that returns are tied to risk true?
I always say that the idea that returns are tied to risk is one of the greatest lies ever told on Wall Street. And investment bankers and investment advisors promote this mythology because as long as the clients believe that they have to take greater risk to get greater returns, the manager essentially escapes accountability. And what they're not told really very often is that the person they're speaking to is really a salesperson. So this person doesn't have the ability to do the work or the desire to do the work. So as long as they tell the client that, look, you could come to your investment advisor and say, hey, here's my capital, I'm going to hand it over to you in this sort of sacred bond of trust, and you're going to be a steward over it. And the manager will almost invariably say, Mr. John Doe, do you want to preserve your principal, or do you want to get better than average rates of return? And the moment that's set up as a dichotomy that's mutually exclusive, that can lead you around by the nose. And of course, for most people, they'll say, I've worked so hard over my life, I don't want to lose my principal. They'll say, I want to protect my principal. Or others may say, I'd like to get better than average rates of return. And they're never presented with the true option, which is you can get protection of principal and get better than average returns by simply having the right approach to capital allocation. And that's a value approach. And once this accountability shifts from the manager or the firm or the investment bank, which is collecting the fees, to the client can come back at some point a later day, maybe a year later, and say, what happened? The S&P 500 is up 20%, for example, and I'm down 5%. We're on the same, Mr. John Doe, we talked about this, and you said you wanted preservation of principal, so we put you in the formulaic schedule where you're going to have a certain amount of bonds and a certain amount of T-bills, whatever, and you lost at a fair game. The market was very bullish, and we were very conservative, but that was your directive. And if he chooses better than average returns, he comes back a year later, he's lost money, the market's up, or maybe he's underperformed in some other way. And says, what happened? The market did very well. I could have thrown a dart at a board and did better. A monkey could have been managing this. What happened? And of course, the advisor will say to the client, we talked about this. You want a better than average rates of return, and we have to take some risks. So we bought some IPOs and we bought some emerging market issues, and we were super highly diversified amongst risk assets. And we bought some Bitcoin and maybe precious metals, and we lost at a fair game. And again, so at that moment, the lack of work of the investment advisor and the institution that he represents is shifted, the accountability shifted to the client. And it's really a fascinating thing because really only on Wall Street where this sort of thing happens, where somebody is paid a fee and has almost no accountability. And the accountability is always on the owner of that capital. And very often, these clients are totally unaware, not only that the person they're speaking to is a salesperson, but there's sub-managers involved and other advisors which are getting a small fee. The fee can be a fraction of a percent. But because these are salespeople whose primary job is to gather assets and to create huge pools of assets, the way the jig really works is that they're really stealing a small amount from a large number of people. And that's a very good business on Wall Street. It's been said that Wall Street's the only place in the world where somebody pulls up in a Rolls Royce to get advice from someone who takes the subway home. The problem arises on Wall Street when one person steals a lot of money from a few people and then they go to jail. But Wall Street, some genius figured out that if you just steal a small amount from a lot of people, they'll celebrate you and you'll build a great firm and it will be very prestigious. Getting back to this original mythology, as long as you believe that risk is tied to returns, you can be led around by the nose. People understand this fallacy very clearly when you move out of the asset class of common equities into something as common as real estate, for example. Most Americans were conditioned to believe after the World War II era, with the creation of Fannie Mae and Freddie Mac and Ginnie Mae, that real estate would be their greatest investment. And even though it's really not, but as a result, many Americans are homeowners, they own real estate, it's aspirational. But if you look at the actual rates of return, when you adjust correctly for inflation, depreciation, I believe since World War II, it's something like 4%. But when you put it in terms of real estate, people get it right away. You say, if you were going to buy a home that cost $500,000 and you could buy it one day for $250,000, you would be taking less risk, not more. And when you went to sell that house a year later or 5 years later or whatever, you would get a better than average rate of return because your price was less than the real value. And then boom, light goes off. They get it right away. For some reason, I guess when it moves to common equities, because prices are quoted constantly and put in front of them, and because of the bipolar nature of the mob on Wall Street, and whether that's retail traders or algorithmic traders or quant funds, it's really letting the madness of a crowd, the chaos of a group of people acting completely irrationally, make financial decisions for you if you participate in something like GameStop. And it's interesting that GameStop talks about online gaming. The name of the company is GameStop. In this case, Keith Gill refers to an Uno card as part of those cryptic symbolic messages he's sending online to ignite this frenzy again. But if you think about it, all of it deals with gaming. That's the name of the industry in Las Vegas, right? It's the gaming industry, which is, again, is a nice euphemism for gambling. But I don't know why anybody who takes stewardship seriously would look at the allocation of assets as a game. It certainly is not a game, and if you look at people who take financial losses, they don't feel like it's a game at all. And so it's hardly a fair game that's being played. And in this case, there's going to be a lot of people who make money, and you're up against some very smart people who have advantage. You might think your brokerage firm and your advisors have incentives aligned with your own, but in almost every case, they're really not. And there's so much going on behind the scenes that the average investor will never see and never know about. I think it really begins with understanding that the common sense that goes into every other form of ownership, the common sense that goes into every other form of stewardship, and the common sense that goes into so many wonderful businesses that people build. America's a country full of small and large businesses that have been built by very creative and enterprising entrepreneurs. They really should consider applying that very same approach to their ownership of common stocks, because investing is best when it's most businesslike. And if you were to tell someone that, hey, I've got a house to sell you, but I'm not going to tell you where it's at, or what it's built from, or what neighborhood it's in, or what the crime rates are, any of this other information you'd want to know before buying a home, you would never buy it. And yet people buy common stocks every single day on the stock market with precisely the same level of ignorance. So really extraordinary. Wall Street has pulled off something quite remarkable in this enormous wealth transfer that takes place every single day, Monday through Friday on Wall Street. And really the cardinal rule there is making sure the clients don't ask too many questions. They might play a million games of golf with their advisors and never stop to ask, is it really true that returns are tied to risk? They'll never question that. And in like fashion, very often, they'll never question their returns. They can tell you in a heartbeat what their tax returns were last year and how much they paid in taxes. You ask them what their rate of return on their assets were last year, or what the compounded rate of return was over the last 5 years. You just all blink every single time. And yet, the compounding their capital will create more wealth for most investors over the lifetime than any job ever could. Really remarkable how you've taken an entire class of intelligent, enterprising, free-spirited Americans, and somehow we go to Wall Street and we lose like 50 IQ points. And the result is, what do we get? We get the GameStop debacle and Mania, which is taking place. I really hope that taking a look at these sort of two companies, similar time frames, similar economic challenges, but one with a significant margin of safety, one with significantly more equity, tangible equity than its share price, and another where you're looking at de minimis earnings, only a penny in the last 12 months. That could change. Maybe the company will improve, but it will take time. The company usually can't improve their economic dynamics too quickly. But what are you really paying for? You're not paying for anything. You're just paying to play. It's a game. And like I said, you can play a lot of other games where you have some benefits. In Las Vegas, for example, it's not going to be any benefits to this game.